Good day, Doctor. In this presentation, we will analyze a modified iron collar strategy using real market option data from NVIDIA Corporation or NVDA. NVIDIA was selected because of its strong position in the artificial intelligence and semiconductor industry, as well as its high trading liquidity and active option market. Based on the historical daily closing prices from May 2025 to May 2026, we observe an overall upward trend despite several short-term fluctuations and periods of volatility. This supports our moderately bullish market outlook, where investors still expect future growth while remaining cautious about the downside risk. Therefore, the main objective of our strategy is to manage risk while still allowing investors to participate in NVIDIA's potential upside performance through a combination of stock and option positions. Next, for the data collection process, real market option data was obtained from investing.com using NVIDIA's option chain database. As shown on the slide, we selected a common expiration date of 20th November 2026 and extracted the relevant option information required for strategy construction. This includes the current stock price, strike prices, bid prices, ask prices, and option premiums. This market data were then used as the basis for constructing and evaluating our modified iron collar strategy.
The underlying asset selected was NVIDIA Corporation due to its strong market presence in the AI and semiconductor industries, making it suitable for options-based analysis. The current stock price of $235.75 was used as a reference point in selecting strike prices that balance downside protection and upside potential. The modified iron collar strategy used a 180 strike put, a 295 strike short call, and a 310 strike long call, with a common expiration date of 20 November 2026 to capture longer-term market movements and to also maintain consistency in payoff analysis. Historical daily stock data from May 2025 to May 2026 was also used to analyze returns and volatility, while NVIDIA's low dividend yield of 0.02% was included to reflect realistic market conditions, although its impact on pricing is minimal. NVIDIA was selected due to its market leadership in the AI and semiconductor industries, high sensitivity to AI demand and earnings performance, and liquid options market, which provides reliable pricing and extensive real-world data for analysis. On the other hand, the modified iron collar strategy was chosen to achieve a balanced risk-return profile where the 180 strike pull protects against severe downside risk, the 295 strike short call helps offset hedging costs through premium income, and the 310 strike long call restores upside potential beyond the short strike under a moderately bullish outlook.
Hey, what's up guys? I'm Daniel Hakimi with metric number 220000520, and let's get into our strategy construction and innovation. So before we understand our strategy, we first have to understand the unique position of NVIDIA. While the company boasts incredible upside potential driven by AI, it's currently caught in a geopolitical crossfire. China-related trade uncertainties and intense market volatility mean that holding the stock naked is no longer a safe bet. Our mission was to innovate a structure that allows us to stay in the game for the growth without being wiped out by a sudden policy shift or a market crash. We aren't just buying a stock, we are engineering a safety net. Now let's understand our risk. We have categorized them into three pillars, which are opportunity cost, downside price, and volatility. For the first one, with a 57% annualized return on the line, we can't afford to sit on the sidelines. And secondly, for the down price, a drop from $225 to $200 isn't just a number. It's a significant capital loss that needs a floor. And finally, for volatility risk, NVIDIA's 33.79% volatility fueled by H200 chip sale uncertainty creates massive price swings. So to innovate, we had to build a strategy that addresses all three, which is to protect the downside, manage the swings, and keep the door open for the forecasted $317 target.
Hi, I'm Padma and my metric number is 230062004. So we have seen the risk implied in the stock that we have chosen. Now I will be explaining about what is the risk mitigation plan in order to build our strategy. So first and foremost, we will buy the NVIDIA stock at the current stock price, which is $225.83. This gives us a direct exposure to NVIDIA's upside potential and benefit us if the stock price increases. Next, we will buy a put option at a strike price of $180 and a premium of $8.50. This gives us a downside protection and limit the losses if NVIDIA stock crashes below a certain point. Thirdly, we will actually sell a call option at a strike price of $295 and with a premium of $14.20. To collect an income premium helps us to reduce the cost of buying the protected pool put just now that I've mentioned. And thirdly, we will also buy a call option at a strike price of $310 with a premium of $11.70. So this is to restore our upside potential and allow us to benefit if the NVIDIA. So now we will look at our innovation. So if you have observed that we are actually longing a stock, longing a put option, shorting a call, and also longing a call option. So it's basically a normal caller which has a long stop, long put, short call, plus another long call. So that's our strategy. So traditional normal caller is too passive, too focused on capping the losses, negating the possibility of a moonshot profit. Thus, adding a long call option really restores our upside potential of the normal caller cap, allowing the strategy to remain protected while still capturing NVIDIA's breakout potential if the stock price rises to a certain point due to its high demand and also the H200 chips that has been approved by the US-China government.
My name is Muhammad Adam bin Suhaimi and I will present for mathematical analysis section. Our total cost basis is 241.75, calculated from on the stock price plus 6 net premium. It represents break-even point where the net profit is exactly zero. We define the strategy through 4 piecewise intervals of profit function. Below 180, the profit is fixed at negative 61.75, defining our maximum loss. Between 180 to 295, the strategy grows linearly with the stop. Between 295 and 310, the gains are offset by short call, creating a 53.25 plateau. Past 310, the long call restores a positive slope and making maximum profit unlimited. Next, these results are shown in our trade-off table. Note that in a total crash, our risk is capped at negative 61.75, while a 400 moonshot scenario yields 143.25 profit. The profit diagram illustrates this visually. We identify the zero closing at our break-even and the final upward king after the 310 strike. This confirms our modified iron collar strategy successfully hedges extreme downside risk while maintaining exposure to unlimited upside potential.
For our practical analysis, we stress tested the modified iron collar against simply holding NVIDIA stock across 3 real-world scenarios. First, in a severe market crash down to $129, a direct stock investor loses over $106 per share. However, our strategy limits this loss to just $61.75 because our protective $180 put caps the downside. This saved the investor $45 per share. Second, in an exponential rally up to $427, traditional collar completely frees your profit at the $295 strike, but our added $310 long call restores upside participation, allowing us to capture a massive profit of $170.25 per share. Finally, in a moderate growth scenario, we give up a minor $21 of profit compared to pure stock ownership, which is a very fair trade-off for complete downside protection. Let's look at the strategy risk-reward profile. The modified iron collar creates a highly balanced footprint with a risk-reward ratio sitting very close to 1:1. Our target profit is around $60.25 per share, while our absolute maximum loss is strictly capped at $61.75 per share. Because NVIDIA is a highly volatile stock, this 1:1 structure offers a perfect conservative balance, and it removes catastrophic downside risk while explicitly preserving the opportunity for explosive future upside gain. To be realistic, we must acknowledge 3 practical risks when executing this strategy in live markets. First, because we sold a short call option at $295, we face assignment risk. If NVIDIA surges past this price early, we might be forced to sell our share at that fixed strike. Second, during period of high market volatility, bid-ask spread can widen significantly. This increases transaction cost and lower efficiency if we try to exit the position early. Finally, this strategy has a depth zone between $295 and $310. Inside this pocket, profit remains capped at $53.25, and our extra $310 long call option will expire completely worthless if the stock price doesn't break above it. To wrap up, we calculated the percentage distance the stock needs to move from its entry price to reach profitability. Our initial stock entry price is $235.75, and our mathematical break-even point is $241.75. This means the underlying stock only needs to rise by a minor 2.54% for our entire strategy to become profitable. When you compare this tiny 2.54% hurdle to NVIDIA's actual annualized historical return of 57.78% from our dataset, it provides that hitting our profit target is highly realistic and very achievable within the option lifespan.
Based on our analysis, NVIDIA has a moderately bullish outlook driven by strong AI and the semiconductor growth, with high annualized return of 57.78%. However, the stock also have high volatility at 33.79%, which creates short-term uncertainty and downside risk. Our strategy balanced risk and return by using the long 180 put to limit maximum loss to USD 61.75, while the additional 310 long call allows further upside participation. The strategy also only needs a 2.54% of increase to break even. Overall, this strategy is suitable for moderately bullish investors who want controlled risk while still gaining exposure to NVIDIA's future growth potential. In conclusion, the modified iron collar strategy creates a balanced risk-managed strategy by limiting downside loss while still maintaining upside profit potential. Compared to a traditional collar strategy, the additional long call restores future upside participation. Overall, the strategy performs well across bearish, moderate, and bullish market conditions, making it suitable for investors seeking safer exposure to NVIDIA's future growth.